Well, I hope everybody is well and had a nice Thanksgiving. It's certainly been a long time since I've done one of these fireside or candlelight chats, and I thought with the market swooning the last few days that I'd just give you our thoughts on what we're doing to position our portfolios and our thoughts about what's going on. I've said over the past year and a half that the economic recovery and the stock market recovery would go a lot in line with the COVID recovery. And certainly the recovery has been much faster and bigger than I ever would have expected. And that has been in effect because of the massive amount of government stimulus, both on the monetary and the fiscal sides. And that's been very good, to the point where now we, of course, are dealing with inflation, which is the second problem of the market, which I'll address today or tonight. So the first thing, of course, is COVID. The other thing I've alluded to over these chats and newsletters over the last year and a half is the Spanish flu. And that took 2 years for us to work our way through the Spanish flu. And of course, we had the roaring 20s after that period of time. And we lost 40 to 50 million people. It was a horrific time period, and we lost a lot of younger people. This particular virus, we've lost older people, and it's had its own impact, and we've lost, of course, 5 million people, and that's still counting. And the virus is doing what viruses do. It's mutating, and we've had plenty of mutations along the way. And we've done fine. And if you look at the one, often a lot of our clients have said, hey, the market hasn't gone anywhere the last few months or sideways. And of course, we had a good October and November. As you get your statements, will be down a little bit with the sell-off we've had the last few days. And that's all to be expected in any market for any reason, especially when you had the external forces of COVID acting upon it as we have. These have been very extreme circumstances that we've worked our way through. The good news is that we've worked our way through. We have just amazing innovations and technology which have allowed us also to recover much quicker with the new RNA technology. And in a worst case scenario, because I always look at the best case and worst case scenario, the worst case scenario is that the new variant, the Omicron variant, is just completely nothing. The vaccines simply don't work against it, and it would take months before the drug companies are able to put out a new vaccine to combat it. But the good news is it'll be a lot quicker than it was last time because the technology is there. And Pfizer, the CEO this morning, was saying how they were getting ready for beta. They were getting ready at Delta if they need be, but the vaccines were still effective, so it wasn't needed for them to put out a new vaccine. I think the best case scenario is probably the more likely, like Delta, that we see these vaccines have some efficacy against the new variant. And regardless, we're not going to go back to shutdowns. Even President Biden was saying yesterday that the country's not going to shut down. That doesn't mean Europe isn't. We've seen plenty of other countries effectively do just that. We have shut down flights. And so certain sectors of the economy could get hurt in the short term. We could see GDP go down. We could see unemployment issues, as we did over the summer with the Delta variant. And of course, we had a quick recovery after that period of time. And those who panicked and got out during the summer simply because of the Delta variant then missed the upturn afterwards. And I think that'll be the case this time. It's the best case scenario and probably the more probable scenario because that doesn't even take into consideration the new therapeutics that are out there that should be quite effective in helping individuals. So again, the first thing is that the economic recovery and the stock market recovery will likely go in line with the COVID recovery. And it's been my thesis since the beginning that we will eventually recover, and we have. And that's the good thing. Just seeing, New York City, people are maskless in those venues where you show your COVID vaccine and you can go into Broadway plays or restaurants. And certain areas, of course, where you get on a flight or get on a subway car, or on the, I take the New Jersey Transit, New Jersey Railroad into New York City, you wear a mask. But then other parts of the country, like North Carolina or Montana, nobody's wearing masks. And the interesting thing about this virus is it's quite insidious. States that have been completely locked down have had spikes, and those which haven't have had certain spikes, but then have come right back down also. So I think that most policymakers understand that it's not an effective way to go about it. So I don't think we're going back to lockdowns or anything draconian that would send us back into anything near a recession. Now the second part is inflation, which we're all feeling, and inflation can be very insidious. There's nowhere to hide from inflation. Cash does poorly, obviously, because your money is going backwards after taxes and inflation, especially interest rates at zero. Bonds don't do well because the rate of return that you're getting is being eaten up by 4 or 5% inflation. And stocks sometimes do well. Certainly value stocks like we buy, the dividend-paying stocks, and cyclicals generally do better than growth stocks as interest rates rise. And so the Fed kind of threw a cold blanket on the market today, but I thought it was a very good statement that they were going to start. They're going to start raising rates sometime next year. They're going to have to combat inflation, and that they're going to taper the bond purchases quicker than expected, barring the variant outcome in the short term, which they may keep some of the purchases in place until they see the results. And it's going to take a few weeks before we know how effective the vaccines are against this particular variant. So expect the Fed to be watching things just like you and I are. What we don't want to do is sell any of the companies we own simply because of what's going on right now, because we don't know. And markets hate uncertainty. They hate instability. But that's part of investing. That's why we get a better rate of return than we're getting from a 0% cash. Getting in and out of the market is always foolish. For our retiree clients, Coca-Cola is going to continue to pay the dividend. Some of the companies we sold over this year we bought when people didn't like them, like Apple. For years, we toiled in Microsoft where it didn't go anywhere. And a couple of years ago, we sold Microsoft. And of course, we sold Apple earlier this year. And we're starting to sell some of even the consumer staples, which the valuations are getting a little bit higher and concerning, and not offering as much protection on the downside, nor do I believe as much upside returns. So we're looking to, and you've seen us replace some of our holdings in the recent months for positions I think will hold up a little bit better in an inflationary environment. I was glad to see that Chairman Powell removed the word transitory. He said we should bury it, I think in other words. But I think he should bury it, because transitory at this point is sort of silly, because I suspect that we're going to have inflation well into next year, especially as the supply lines start to work themselves out. So these are the two things right now that are giving the market some pause, that the Fed's likely to be raising rates and certainly and more aggressively reducing the bond purchase programs that they've had in place, and probably raising rates. Some Fed governors have said a couple of times into next year, and may have to do so even more rapidly than that. We have economists, we have two great periods in time to look at when fighting recessions, and one of them, of course, is the Great Depression, where we knew that government stimulus and Keynesian economics was very helpful to stimulate. Deflationary environments are much harder to combat, because the government can print all the money they want, but you and I aren't going to borrow it, and banks aren't going to lend it, because we all tighten up. The other economic period of time we have, and many of you remember the early 80s when we had very high interest rates, and Paul Volcker had to raise interest rates to stifle inflation. It's never politically palatable, but it's very easy to fight inflation. When you raise interest rates, companies won't borrow as much, people won't get as many mortgages, credit card rates go higher, so people don't borrow against or spend as much either. So the good news is, too, that the American consumer is in very good shape. This has been the only period in time I've been showing our team these statistics, the only period in time in history when we've had a recession where the American consumer is actually better off. and consumption actually went up, and savings actually went higher. And that's because government programs paid people to stay at home. And we had the PPP programs for business owners. All of that was very stimulative and kept the economy rolling. So individuals and businesses are in much better shape. Corporate profits are very, very sound and very, very good. And remember, stock prices over long periods of time follow corporate earnings. I don't know what my company is going to do in the short term. People say like, oh, what do you think the market's going to do in the short term? I have no idea. I know one thing. We're not going to speculate on crazy speculations. I'm not even going to call them investments, whether it's cryptocurrency or some company that doesn't even have earnings yet. They may have some revenue growth on the top line. They don't pay a dividend. The valuation is obscene. That would be like somebody offering me, $100 million for my company. As much as I plan on working until I'm dead, and hopefully that'll be, until I'm 80, 90, 100 years old. If somebody offered that type of silly valuation, I'd be foolish not to accept it. And that's ultimately what you're doing when you're paying so much, 300, 400 times earnings for a company in the hope that it continues to grow. We just don't do that at Altrius. We buy companies that are selling at reasonable prices, that pay our clients dividends to weather these inevitable storms that come throughout life. And they're often difficult, they're often unsettling, especially when you see your portfolio values go lower. But it's part of investing. I always say, don't worry about it. Your income's not going to change because Procter & Gamble is going to pay you the dividend. The companies we own are going to pay you the dividend. Of course, it's not guaranteed. Those companies could cut their dividends, but we're generally buying companies that have increased their dividends over many, many years. And we believe in the soundness of the dividends, even should their earnings get hurt in the short term. So as difficult as it is, and as much as the press now is going to put out story after story about how horrible this is, I think we'll find this is just another period of time that we were glad we didn't act rashly or speculate and throw it on any kind of other speculation that may be out there, and in the hope that our portfolio goes up. I think acting rationally and soundly is always the prudent way to go, and acting foolishly, whether putting it all on a particular football game this weekend or betting it all on black or some gambling thing is just not what the stock market is all about. The stock market's about investing in companies for the long term. Just like I invest in Altrius Capital and continue to invest in our people, continue to invest in technology for both our clients and our firm. Companies are doing the same thing and thinking long term, not for the next month, not for the next quarter, not even for the next year, but for the decades to come. And for many of you, you say, oh, well, I'm only 60 or 70, or I'm not going to be retired that long. People are living much longer and better lives. We have hopefully decades to go. And it's important that we invest long-term and think long-term. And that's what's nice about the dividends. The cash flow is there for us, regardless of these crazy ups and downs. So again, just to summarize, the two things right now that I think are shaking the markets are certainly the COVID variant, Omicron, and also the inflation fears and the Fed comments. Neither of which I think will derail this recovery. I don't think the Fed is in jeopardy of raising rates too quickly to stifle or have to stifle the economic recovery. But we could certainly go through a period of time where they need to raise rates to where growth will slow because investment from corporations or from individuals will certainly slow. But that shouldn't hamper our desire to be investors long-term in the companies that we're investing in. As always, I appreciate all the trust that you put in our firm. It's not something we take lightly. And if you have any questions, feel free to reach out to your specific financial advisor or to me. I'm always up and always working, so call or email me anytime. All right, thanks a lot. Stay well and enjoy the holiday season with your family. All right, bye-bye.